US Treasury bond yields are very low, signifying there's nothing to worry about, US government. Keep on spending like crazy, even though your debt to GDP levels are through the roof. That doesn't make sense. Why are bond yields so low? Aha, say some people. The reason they're so low is because the Fed is stepping in and buying up all the supply. Maybe that's what happened. We're going to ask Jeff Snider, the head of global research for Alhambra Partners, to tell us what happened at the most recent 20-year bond auction. Apparently it went very well. Is that because the government, the central bank, is buying up all the supply and that's why bond yields are low?
Yeah, that's the central point, or at least one of the main points of quantitative easing. It's always been about, at least in the public mind, about lowering interest rates, right? And it sounds like it should. It's very intuitive. The government or the central bank isn't buying bonds for economic reasons. It's a non-economic actor. And so it's just buying bonds, which should increase the price on those bonds because it's additional bids for securities that are out there in the marketplace. And of course, higher prices means lower yield. So at least in theory, it sounds like quantitative easing would be consistent with maintaining lower yields, especially if the pace of quantitative easing is extreme or large or huge. If the Federal Reserve is buying an enormous quantity of bonds, how could that not keep a lid on lower interest rates? At least that's the idea. And, you know, as we've seen over the last couple months with interest rates rising a little bit, it has been really underwhelming how much the reflation trade has gone. And so that brings back the question: is it because our interest rates? Is it because that the Fed is doing a lot of quantitative easing over the last year? Is that the reason why interest rates haven't gone much higher than maybe they would have if the Fed wasn't in there buying a lot of treasuries?
In episode 60, we discussed the findings or conclusions of the Bank of New Zealand, the central, what is it called? The Reserve Bank of New Zealand.
Yes.
And they told us that indeed they find that quantitative easing does help yields go down. But as we reported in episode 60, it was by a surprisingly small amount. And in this article, you tell us, you quote them. Oh, by the way, the article is called The QE Nundrum. The QE Nundrum. You can find it at Alhambra Investments, and it was posted on April 21st,
Should we call it the
2021.
QE Nundrum or the Quanundrum? Or maybe we need to call it, I like the Quanundrum.
Okay, perfect. Type that into your Google machine, the Quanundrum. And Jeff, what did New Zealand tell us? How much did yields fall
10% of GDP, a large-scale asset purchase of 10% of GDP lowers bond yields by 7%. I mean, that's what you would think, right?
7%?
No, it was 50 basis points. I mean, 10% of GDP is an enormous amount. And why wouldn't it be 7%, right? Because it's absolutely massive. And yet you're telling me, on average, through a bunch of statistical studies conducted by the central banks themselves, or, you know, the BIS or IMF, all of these studies suggest that at best, at most, on average, there's a 50 basis point reduction for a 10% of GDP program, which is really kind of pitiful. It's massive bond buying and only a little bit of reduction in yield.
Jeff, can you tell us how much as a proportion of GDP has the Fed bought over the last 13, 14 years?
Over the last, well, it fluctuates up and down, but over the last year or so, it's been a little bit, it's been around 10% of GDP.
Okay, got it. So 1 year's worth of QE comes out to about 10% of GDP, at least at the Fed's pace. And that contributes to 0.5% reduction because rates were already falling.
Right. So that would tell us that right now we would expect, giving them the benefit of the doubt here and using New Zealand's, you know, schematic or framework, they would say that 10-year should be what, 2.1%, 2.2%, somewhere around there. And really most of the academic literature is actually much less kind than 50 basis points. So 50 basis points is kind of like our top end range for QE's impacts. And so we're, you know, at most, we would expect, according to all of these statistical studies, we would expect that the U.S. 10-year Treasury might not be much more than 2.1 or 2.2% anyway, which again, that's really not out of the line of past reflationary periods. It's certainly nothing abnormal or out of the ordinary. And giving everything that's going on right now, it still leaves us asking the same question: how could bond yields be so low?
Well, Mr. Richard Fisher answered that question years ago, because the market is buying these things. And so he was asking, why are we buying what the market wants to buy anyhow?
Yeah, and that's really what you see in these studies, and what the Bank of New Zealand was talking about was the reason why even massive QEs don't really lower interest rates is because the market has already lowered interest rates for very different reasons. And so QE kind of comes in after rates are already falling, which is what Richard Fisher was talking about. Investors are already fleeing toward these assets. And then the central bank comes in and says, we're going to lower interest rates by buying bonds, that the market's already buying bonds and has already lowered interest rates. And so, I mean, Richard Fisher, of all people, said, this is kind of stupid, isn't it? This is kind of circular logic and silly. How is it that when the market lowers interest rates already, and then we come in and lower interest rates a little bit more, how does that make it stimulus?
The crux of this article here is what we just heard you say, and what Richard Fisher was saying would suggest that it might be pointless what the Fed is doing, or a waste of time, or mildly helpful. In this article, you do some math to come to perhaps the conclusion that it's not just neutral or pointless, that it might be harmful. So can you tell us the journey that we're going to go on? We're going to pull up some graphs and tables, and we're going to try to understand how QE is doing what that might not just be pointless.
Well, first of all, quantitative easing is not money printing. It is an asset swap. And there are two sides to the asset swap. And we're only supposed to focus on the one. That's certainly the one the media and the central bankers focus on, which is the creation of bank reserves, which is just an accounting byproduct of all this. But it's the increasing level of bank reserves that happen at the end of this transaction. When a commercial bank engages with quantitative easing, selling with the central bank, it ends up with a larger balance of bank reserves on account with the Fed. However, there's the other side of the asset swap here. Before this transaction began, the central bank had some kind of asset to sell the Fed in order to end up with these bank reserves. And in this case, we're talking about US Treasuries, but there's also other assets that central banks have bought, mortgage bonds and mortgage-backed securities and things like that. But here we're going to focus on US Treasuries because that's really in the current day and age, that's really where all the focus really should be on. So in our asset swap, the commercial bank starts with a government US Treasury bond, and at the end of the asset swap, it has bank reserves, which means it no longer has the US Treasury bond. The Federal Reserve has the US Treasury bond locked away in its SOMA portfolio. Now, it says it's not locked away. We have this reverse repo program where banks can lend it or can rent this collateral from us if they need to. But, recent history has shown the reverse repo program does very little to help alleviate, which is what we're talking about here. Once those bonds leave the commercial banking sector and end up in SOMA, that's less bonds for the repo and derivatives markets to use as collateral, because as we know, we've talked about this many times before, collateral is not a single thing. It's not static. It's repledged, repurposed, reused, and rehypothecated far and wide all across the entire world. So bonds taken out by quantitative easing are bonds that are no longer usable, or at least usable on the same terms in the same way as they had been before QE. So yes, bank reserves go up, but something else happens on the collateral side. And what is that happens on the collateral side? We need to really think about that and figure that out.
In episode 62, we discussed what a pair of researchers concluded is that something else. And the research was done in December of 2020, at least that's when it was published. And they concluded that for every $33 billion increase in weekly Fed purchases, it resulted in a 0.5 increase in the collateral chain. That 0.5, that means 50% more, right, Jeff? So,
no.
Okay, so tell me
Yeah,
what
Collateral multiplier, collateral chains. The idea is, going back to rehypothecation, reuse, repledging, a single US Treasury might be reused as many as 6 or 8 times at least according to the academic literature, which means that a collateral chain, a single bond is used 8 times, the collateral chain is 8.0. So what they're saying is that when the government comes in with, or the Federal Reserve comes in with quantitative easing and removes $33 billion a week in US Treasuries from the system, the actual collateral change has to stretch 0.5 times, or 0.5 points more. So instead of 6.5, in order just to have the same amount of collateral available to conduct the same amount of repo and derivatives transactions, all these other things. So the Fed removing collateral means that dealers have to do more repledging, more rehypothecation, just to make up for what the Fed took away from them. And as you can already start to sense, I hope, that can't be a good thing. That there's got to be some kind of downside negative consequences to making dealers do more just to stand still. The Fed is raising the level of bank reserves at the same time it's taking collateral from the system. And maybe, the bank reserves aren't really useful, but that collateral sure is. I mean, it's being reused 6 or 8 times. And if you actually talk to people who actually work in the system, they'll tell you it's probably much higher than 6 or 8 times. That's just what gets reported. It could be 20, 30 times so I've heard some people whisper about. And so collateral, highly useful, gets reused all throughout the nuts and bolts of the financial system. Bank reserves not really used much at all, except to write media stories in Bloomberg and things like that. And look at the bank reserves are way up. So you see bank reserves go up. You're supposed to be impressed about quote unquote money printing. But what really happens is collateral disappears, or at least gets locked away from commercial banks to use it in a way that they really need to.
The way commercial banks really need to give people a sense of what that means, how commercial banks really need to. You quote Morgan Stanley from its annual 2020 report on page 117 in the footnotes. I'm going to read it, Jeff.
All the good stuff is in the footnote. There's nothing. I mean, if you want to know anything about banking and the modern monetary system, you got to go into the footnotes. That's where everything is.
One of your famous articles is called Footnote Dollars, where you found trillions, $10-14 trillion worth of money that had previously been undiscovered. The BIS, I believe, that they had done that. Is that right?
Yep. And here we are with footnote dollars again, except here it's in the form of collateral.
I'm just going to read a sentence because let me give it a shot here. The firm receives collateral in the form of securities in connection with securities purchased under agreements to resell, securities borrowed, securities for securities transactions, derivative transactions, customer margin loans, and securities-based lending. In many cases, the firm is permitted to sell or repledge this collateral to secure securities sold under agreements to repurchase, to enter into securities lending and derivative transactions, or for delivery to counterparties to cover short positions. Jeff, that amounts to $724.8 billion for Morgan Stanley alone.
Yeah, listen to what they're saying. They're saying we do a bunch of stuff you don't know about, and it's a wide range of stuff. And the number you just said, 700 some odd billion with a B, 700. And this is just one bank. This is just Morgan Stanley. That's what they've received, collateral they received, that they do have the right to repledge or reuse in some way. And then they tell you that of that 700 some odd billion, they have repledged, at least by the end of last year, and maybe it was more before their year-end window dressing, but at least at the year-end window dressing, they say they did repledge more than $500 billion, 500 billion with a B, just Morgan Stanley. That's the amount of collateral that's been repledged by this one Wall Street bank at the end of last year.
Just to give people a sense of what size that is, that 724 billion. If you add together the global iron ore market, the global met coal market, and the global natural gas market, that's over $700 billion. That's what Morgan Stanley is repledging or has available to repledge. Unbelievable. Okay, so Jeff, what you did is then you went through a stylized experiment to just get a sense of what might be happening with QE taking collateral out and affecting more than just one bank. So you pulled in 3 banks. Which are those 3 banks? Let me pull up the chart that you put together and you walk us through it.
Yeah, I said in the article I did a random sample of 2 additional. I used Morgan Stanley because I already had the numbers. I didn't feel like going back to Edgar and looking up different ones. But I used Goldman Sachs and Citigroup, just picking them out of the hat. They happen to be the ones I focused on. And they're really, all 3 of these are representative of what really happens at the big banks anyway. So it's not really like there's a tremendous amount of differences. And as you can see by the numbers, even the reuse rates are pretty close. I mean, there's a couple of differences here and there, but by and large, these are massive numbers. Here's 3 banks where, for the last couple of years before 2020, they were reusing, repledging, rehypothecating collateral of about 1.4 trillion. That was what they reported doing in terms of reuse for those 3 years, on average, about a little bit more than 1.4 trillion. And where it gets interesting, where we're really starting to, what we're really going here is that if the Federal Reserve, if our idea that the Federal Reserve is creating problems and ripples in the collateral market, what we would expect to find, what we should find, is if the Fed engages in massive amounts of QE in 2020, we would expect there would be a lot more reusage in collateral. And lo and behold, we look at our sample here, just these 3 banks, we see a massive increase in the amount of collateral that was repledged by these 3 banks, almost 16% year over year, when there hadn't been much change in the collateral repledging in the 3 years prior.
Right. So we go from 1.4 trillion for the 3 banks, which we see every year, 2017, 2018, 2019. In 2020, those 3 banks, it jumps up to 1.7, as you say, 16% increase. And now you start multiplying it to give us a sense of the amount of treasuries that are seemingly available, right? Because it's 1.7 trillion securities available for repledge, then multiplied several times. How many times? You chose 6.
Yeah, just to give us a sense of what we're doing. So I used the low end of the academic range, which, remember, was 6 to 8 times for our collateral chain. So if we just, using the 2019 total, which was 1.486 trillion from just these 3 banks, multiplying that by 6 times, we would expect that there's somewhere around 9 trillion in total collateral being used throughout the system based on just these 3 banks. And so if we assume in 2020 that there's a 16% increase in reusage, and we assume further that reusage is because of a higher multiplier rather than collateral being introduced into the system, then what we're finding is that what we would expect then that what we work out to find is that the implied multiplier in 2020 must be somewhere around 6.93. So making these assumptions that the banks didn't get more collateral posted to them, they had to stretch their collateral change, as that paper we discussed, as common sense tells us, reuse rates must have to adjust for the Federal Reserve taking on collateral. That would imply an increased multiplier of up to around 6.93, which means dealers have supplied about a little over 1.3 trillion, or just short of 1.4 trillion, in additional collateral through a higher multiplication that is missing because of quantitative easing. It was the October paper from the Federal Reserve, which said that at a $33 billion weekly pace, or increase in weekly pace of quantitative easing purchases, that led to an increase in the collateral chains of 0.5 points. So from 6 to 6.5, essentially. And when we actually do the math here using the Fed's numbers, what you find is that in 2020, the weekly pace increased from practically 0, because remember, quantitative easing before the repo mess in September 2019 led to then not QE, which was QE5. So basically the Fed's holdings of US Treasuries in 2019 was pretty flat for the year. It's actually a little bit lower for most of the year. And then in 2020, obviously the big increase in quantitative easing because of the mess with the global financial crisis in March. So you have an increase in weekly pace of about 40 some odd billion a week, which if we apply the 0.33 or the 0.5 for 33 billion, what we anticipate is that gets to what we should see is a collateral multiplier reuse increase of 0.66 points. So if we're assuming 6, it should be 6.66, which is, of course, pretty close to the 6.93 that I figured from just using a bunch of assumptions and starting from these three bank totals. So it is, what we're saying here is that these numbers and this intellectual exercise is at least consistent with the idea contained in the paper. And it's actually, the number's a lot closer than I thought it would be. But anyway, it's at least consistent with the idea that the Federal Reserve is stripping collateral from the system, forcing dealers to then do a bunch of stuff that maybe we don't really want them to do. Rehypothecate and reusing treasuries is actually increasing the systemic risk and increasing the systemic pressures on these vital monetary spaces. And that's really, you know, the whole point here was to say, this is what we expect to happen, and this is kind of what we found. Now, we're not really, this is not a scientific study. This is not meant to convey any sort of precision or accuracy. It's not meant to say this definitively was going on. What we're trying to do is both illustrate the concept as well as, you know, give ourselves a little bit of a check to see if it's a realistic. At least we didn't say that this could not have happened. The data is at least consistent with the idea contained in the paper, as well as contained in, you know, any number of years that I've said that this is what's happened with quantitative easing, that it has negative effects that we really need to appreciate. And those negative effects are that it removes collateral from the system, which you would expect then that not only does it raise the risks, the systemic risks in the system, it makes that collateral more valuable, but not for stimulus or good reasons, for bad reasons.
That's right. So the implicit assumption is central banks are buying, and we're told from the academic studies that yields go down by 0.5%. Okay, and we make the implicit connection. They go down by 0.5% because central banks are buying. But you suggest to us, maybe it's not that. Maybe it's the consequences of central banks removing collateral that the private system then comes back in. So it's an indirect effect that the private system is even more desperate to get their hands in collateral.
Instead of a direct positive effect being stimulus, which is what we're taught and what we're told to believe, it's an indirect negative effect that just piles on to, remember what we said before, interest rates are already falling, already declining. Investors, the marketplace, the banking system is already piling into treasuries anyway. And here comes the Federal Reserve stripping this collateral that the system really wants to get its hands on, making them even more valuable. So that last 50 basis points in quantitative easing, lowering interest rates, may not be the good 50 basis points of stimulus. It might be the bad the 50 basis points of less collateral available for the system. And there's even more negative effects than that that are not contained specifically in, you know, this, does it lower yields? There are systemic consequences that paper we reference also talks about, which says that, you know, raises the issue. Do we really want the banking system to make these long repledging high multiplier collateral chains that underpins not just the repo market, which is the central monetary backbone of the entire global system, but also all you know, 14 trillion in footnote dollars in derivatives too. So we're making it much more difficult and much more risky to engage in basic and necessary monetary actions, which is not a good thing either. So, you know, we're told, hey, let's focus on the bank reserves. The Fed helps by lowering interest rates, money printing, all this stuff, when in reality, it might be exactly the opposite case where the Fed is actually doing more harm than help.
Jeff, was there anything that we didn't cover in this kind of complex, lot of numbers article? Is there anything that we didn't cover that you wanted to bring up before we bid the audience an adieu?
Yeah, I just want to reiterate again that, you know, what we're doing here wasn't intended to be proof. This is not evidence. It was just an example to, first of all, to get people thinking these numbers are big. And so this really can have some really good explanatory power about what we're seeing with bond yields. And the other thing is that, yes, it's consistent with the idea that QE has this negative effect. We found the negative, we at least found the idea, or at least consistent, the data that's consistent with the idea that there might be a negative effect, because the banks did report that they're reusing more collateral and they have more collateral available to reuse. And that was specific to 2020, which is when the Fed went nuts with its QE6. So everything is at least at the start, you can do a deeper investigation if you wanted to, but from our very limited perspective, what we found is what we would expect to find. So at least is a very cursory example. It does comport with the idea that QE may not be doing the positive things, and therefore low interest rates may have an entirely different explanation, which is, as we always say around here, entirely consistent with the interest rate fallacy, which is that low rates are not a good sign. They are not stimulus. And if the central bank is indirectly causing rates to go even lower for these reasons, that is absolutely the interest rate fallacy personified. Tighter collateral, longer collateral chains, that is definitely tight money.
Jeff, thank you for shining some light into the monetary shadows this week. I appreciate it. I hope you enjoyed the show, and I'll talk to you again next week.
Okay, take care, Emil.